It's time for the Federal Reserve Central Bank to cut short-term interest rates. But what exactly does this mean for liquid asset markets and the economy? The stock market is pressing all-time highs while the economy continues to slow, measured through falling employment, weak sales, weak production, and a weaker manufacturing sector. The housing market is also trash. The economy is sluggish. In macro, we'd say the business cycle is subdued, constrained, sluggish. It needs a boost, and that's exactly what the cutting cycle would bring. The only positive is that inflation is falling like a rock, which allows the Federal Reserve to be more aggressive with the rate cuts. Now, switching over to markets, things are a lot more complicated because stocks are driven by multiple factors: earnings, liquidity, and investor sentiment. Now, the first half of 2024 was led by tech, with Nvidia at the helm, until midway through summer when month-over-month inflation collapsed, a leading signal for the market to expect sooner rate cuts. So markets began a vicious rotation out of tech and into cyclicals, or interest rate sensitive stocks. These are assets that would gain the most earnings potential from rate cuts. Technology was probably overowned anyway, and the earnings growth rate peaked, making them less attractive than more cyclical names who were already underowned. As of September, the market is being led by a mix of cyclical and defensive sectors. Cyclical assets should see the largest benefit from rate cuts as they depend heavily on financing. Home builders and real estate are leading the cyclical rally, while the defensive sector is being led by utilities, staples, and fixed income bonds. And these are assets that perform better while the economy is sluggish. But a lot of investors have their eyes on small caps, ticker symbol IWM, the most volatile, underowned, beaten down index, which is heavily weighted by regional banks and biotechnology, with companies who are riskier to own because they're not exactly profitable. So a lot of professional analysts predict small caps have the most upside. But if you ask me, crypto has the most upside potential going into the end of the year, but that's a story for next time. Now, when the Fed cuts rates, the theory is that cyclical industries will see their interest costs decrease, earnings growth accelerates, and gives them more leverage to expand, adding more jobs to the economy. But that's the positive outlook. The fact that defensive stocks are so strong tells us investors are hedging for a growth scare. What if the Fed is too late? What if they don't cut enough to actually rebound the economy, at least in the short term? In this scenario, bonds gain momentum as the economy slows, and historically, bonds surge when growth collapses into recessions. The Fed will cut rates. Whether 25 or 50 basis points, liquidity will rise, money supply will increase, and the financial cycle will pick up to fuel the economy. The question is, are they already too late?